Three.
Por la nostra soluti,
Lepti sensua eterni,
sensua eterni,
vita nostra soluntivi.
la nostra soluti.
Hello, everyone. This is your old buddy Romulus with Backpack Trader. And today we are going to be talking about the Federal Reserve. That's right, the Federal Reserve. Why? Because interest rates are going up. Well, they've already been going up and they keep on moving. This has massive implications for everything in your life, not just the stock market, everybody, but everything in your life. Let's start getting into it. Okay. First of all, backing up just a little bit, interest rates are incredibly important. It's how much you pay to borrow money. If you go to the bank today and ask to borrow money for a car loan, they will charge you some kind of an interest rate. I mean, JP Morgan, Bank of America, and all these other big banks and brokers, they don't get rich giving money away for free. They charge for it. We are not the only ones that pay interest when we borrow money. Governments do as well. The US federal government, which is the largest, most indebted entity in the world, it has more debt than any other government, company, individual, state, anything, anywhere on earth. They borrow money as well. And they borrow money over different time periods. Right now, if the federal government borrows money for 10 years, they will pay 2.35% to borrow that money for 10 years. If they borrow money for 2 years, they'll pay 2.17% to borrow that money for 2 years. This is incredibly important because something happened yesterday that hasn't happened in over 3 years. Worthy of our attention, everyone, without any question. Interest rates, the Federal Reserve, the stock and bond markets are all interconnected. Right now, if the government borrows money for a 2-year period of time, again, they'll pay 2.17%. Look what they were paying just 6 months ago. They were paying 0.2%, 0.2. Now they're paying 2.17. Let's go to the 10-year. Again, if the federal government borrows money for a 10-year period of time, they do it right now, they'll pay 2.35%. Going back about 6 months ago, they were paying 1.28%. So for 2 years, they were borrowing money at 0.2. 10 years, 1.2. Today, you noticed those spreads, the difference between the 2-year and the 10-year has narrowed quite a bit. 6 months ago, the difference was over 1%. Today, the difference is less than 1/4%. What is that telling us? Well, professionals, experts, talking heads, top money managers, economists around the world believe this is telling us the economy is going to slow down. I've been saying for a week that we are already in a recession. 6 to 12 months from now, they'll wake up and tell us that we've been in a recession for a while. I'm telling you, we're in one today. And why is the difference between those rates on 10 years and 2 years so important? What is that really telling us? Well, if we're in a recession already, or if we get into one later on this year, that means that all the inflation that we're experiencing, whether it's paying more to fill our cars, paying more at the grocery store, all the things that we're buying, we're paying more money for lately. If there's a recession, there will be less demand. If there's less demand, the prices for all those things will start to come down. But that's down the road. That's in the future. We have an inflation problem right now, however. So the market participants are saying that down the road, this is a 10-year, the rates can come down as prices of the things that we buy every single day in order to survive will start to pull back and come down as well. But we are dealing with higher prices right this second, which is why the shorter term interest rates are going higher. The longer term rates are going higher as well, but not as fast. on a percentage basis. Something happened yesterday, though, that hasn't taken place in over 3 years. Again, to borrow money for the 10-year, a 10-year period, the US government is paying 2.35%. To borrow money for 5 years, they're paying more than that, 2.36. And to borrow money for 7 years, they're paying 2.39. Typically, the longer term for the loan, and if you're going to go to the bank and borrow money to buy a car for 2 years, they'll charge you 3%. But if you want to borrow money to buy a car for 5 years, they'll charge you 4%. Why are they charging more money for the longer term? Because it's less predictable. More things can happen over 4 years or 5 years than what might take place in 2 years. The bank believes that they can predict with a higher degree of accuracy what's going to happen to you, to the car, to the loan over 2 years than they can over 4 or 5 years. So if they're going to lend you money for 4 or 5 years, they want a higher rate of interest to get paid for taking on more risk because they don't know as much, they don't have as much accurate information to predict. But that's not what's been taking place lately. Since yesterday, the shorter term bonds for the US government are now yielding a higher interest rate than the 10-year. That's called a yield inversion. The biggest yield inversion that the professionals watch is the difference between the 2-year and the 10-year. That has not inverted yet. The last time that inverted was late February 2019. Mark that date, because in a moment, I'm going to explain exactly what that means for us. My name is Romulus. I'm with Backpack Trader. Troy and I exist professionally for one reason and one reason only. That's to help you become better traders and investors in as little time as possible so that you can go to the beach, you can backpack, spend more time with your friends and your family, doing anything you want to do other than sitting in front of a computer and trying to figure out these trades for 90 hours a week. Okay, as I was mentioning, the 2-year is now closing in on the 10-year. Dating back to the early 1970s, this inversion that might take place, it hasn't yet, but it might take place, where the 2-year has a higher yield, a higher interest rate than the 10-year. Going back to the early 1970s, it has accurately predicted all the recessions that we've experienced. The last time it happened was late February 2019. What happened 1 year later? The COVID recession. This stuff works. It has a bit of a lead time. It's sort of a blunt instrument when it comes to the timing of it, but it does work. That's why you need to pay very close attention to what's going on inside of this bond market right now. Stock market has been pulling back, rebounding here over the last couple of days, but pulling back from those early January highs in anticipation of something like this. Interest rates going higher, stock prices going higher. Your world is about to change. You're feeling it when you go fill up your car. You're feeling it when you go buy food for your family. But that's about it so far. You're still going out, spending money on entertaining yourselves. The restaurants and the bars and the venues are all packed right now, post-COVID. But that will change. In 6 to 12 months, that will be all different. Stock prices will be lower. Bond yields will be higher. Bond prices will be lower. How significant and how far can things go? Too early to tell right now. Just like on the upside, when the animal spirits get going and start to drive asset prices higher to unexplainable levels, the same thing happens on the downside. Too early to tell right now. We have a lot more explanation to go over with in terms of bonds, interest rates, and stock market interaction and how we can profit from all of this. So right now, hit that subscribe button that you see in front of you on the YouTube channel right now. Go ahead, hit it right now, hit the subscribe button. Also, hit that like little thumbs up thing so that going forward, you know exactly when we post a video. And do me a favor, tell all your Facebook groups, post it on Instagram and Twitter, that Romulus is now back on YouTube, coming from the forum in ancient Rome from 2,700 years ago to bring you the most advanced and helpful trading and investing information known to man. I'm going back to the forum I'll be back tomorrow. Join us.
Affermente sosa Libia,
Affermente sosa Libia,
vola d'aquila legionu,
vola d'aquila legionum,
sopra terra Britanorum.